Good morning, everybody. We have Jacob Whitish from the UK Trade Agency, Mike Siegel from 500 Startups Fintech Incubator. We have Matt Kane from
Jeff Kane.
Jeff Kane from, you're not the pitcher for the Giants.
I wish.
Jeff Kane from Yodlee, and then Matt from Ernst & Young. He's been with them for a fintech program. And by the diverse makeup in terms of their background, we have Yodlee, which kind of represents what I'll call Web 1.0 financial disruption, and then Mike with 500 Startups, which is kind of more Web 2.0 financial disruption. EY kind of represents the corporate side of things, what's happening with big financial institutions and how they're dealing with all the innovation and disruption, two lovely buzzwords happening in the industry. And then Jacob provides the perspective from London, which is probably one of the top centers of innovation in fintech. And to that point where, the topic of the panel is fintech disruption. And what I want to do first is to help level set and give all these gentlemen a chance to kind of, give you their perspective on their backgrounds and kind of what we hope to accomplish in the 30 minutes or so that we have on stage, but give them a chance to describe what they do, how they're doing it, and but the key theme here is, in terms of fintech disruption is what's the coolest, the latest and greatest coming out of Silicon Valley and the other innovation centers like London around the world, how it's impacting, how big institutions are responding, either through investment, acquisition, partnering, or just buying the services or whatever, and how these two disparate worlds are coming together. So I'll just go ahead and start with Jacob.
Sure. So as Peter said, I'm Jacob with the British Consulate here in San Francisco, specifically working with financial services and professional services companies that are looking to expand between the US and the UK. So there's a very particular window of time that I see a lot of different companies, and it's usually right around that kind of Series A to Series C mark of companies that they have something real, they've actually validated their markets, and they're looking to enter a second international market. Now with that, we're also working a lot with the corporates, large financial institutions, and then helping connect the people in those large institutions with the people in these different fintechs that are looking for help, looking for customers, looking for partners. So it's kind of a pretty broad sense of where I'm working with these different companies. So I'll kind of leave it at that for my intro.
Okay.
Mike?
So I am a VC. Right, 500 Startups is a venture capital firm. Been around since 2010. We do pre-seed and seed stage investing. We're actually the most active investor in the world. We've got about 2,000 portfolio companies in 62 countries. I help run the Fintech program. We're also the most active Fintech investor in the world with about 250 companies in 26 countries. I've done 55 early stage fintech investments in the last 24 months. We also work with banks and insurers to help them understand what's going on in this digital transformation of financial services. We have about 80 of those globally that we work with. So the perspective that we come with is that financial services is going through now the transformation that media or retailing or any number of others have gone through previously. And so what we see is going to happen, much like any other industry before, is that the shape of the industry is going to change, but that doesn't mean that traditional incumbents are going to go away. It means that some traditional incumbents are going to adapt, and the ones who don't are going to be killed by the ones who do. And then you'll have some new entrants, some startups that achieve some level of scale. And together, the adapting incumbents and those startups that achieve scale, that's going to be the new normal.
Okay. Hi, I'm Jeff Kane. I run Yodlee's incubator. Yodlee, as Peter said, has been around since 1999, the world's oldest startup. We aggregate consumer and small business financial information. My job is to go out and find early stage, sometimes very early stage, startups who want to use that information, and we throw resources at them to accelerate their time to market. Resources include 12 months free access to our APIs, which actually have been completely rebuilt and are now fully Web 2.0, 3.0, 4.0, whatever we're on now, our APIs are that. We also have mentors, experts, and a pretty significant network because we've been doing this for 18 years. Yodlee has, I think, 600 bank customers worldwide. Our parent company sells software to over 90,000 financial advisors. So we have a fair amount of leverage that we can deploy to help companies in the program. We've had 4 cohorts of 8 companies each. And I'd be remiss if I don't say applications are open till the end of this month for our 5th cohort, which starts in January. So if any of you have a startup that wants to access consumer financial information, please come talk to me.
And just a question on that: do you guys invest for a piece of the?
We do not invest. We take no equity, which makes it a very founder-friendly program. We don't provide any cash either, but depending on your user count, access to Yodlee's APIs for free can be worth $100,000 to $200,000.
And then how about access to your greater network of financial institutions that you have prior relationships with? Is that a piece of the puzzle?
That's a piece of the puzzle. So mentorship, introductions, and just like Mike and his program, we know a lot of people, we know a lot of VCs, and we support our portfolio companies however we can.
Okay.
Good morning, my name is Matt Hatch, partner at EY here in San Francisco. I'm responsible for Fintech across the Americas region for EY. In our Fintech program, we are looking after the relationships we have with all high growth, innovative Fintech companies. So from early stage up to maturing and going public. We also work with a lot of incumbent financial institutions around their innovation agenda. We are very focused on entrepreneurship. We've got several programs globally that we run. Entrepreneur of the Year is our largest, and then Entrepreneurial Winning Women. Really trying to help entrepreneurs be successful and be connected throughout the ecosystem and grow and scale their business. To the tee-up question, when I think about sort of the future of Fintech, I think there's a lot of interesting and exciting innovations that have come up over the last couple of years across the entire ecosystem, financial services, and some in isolation. I think we're going to start to see a lot of that come together, and there's going to be a lot more personalization in the years ahead that we currently don't experience as consumers. I think the other side of it for me that I'm very focused on and very excited about is a lot of the innovations in Fintech over the last 10, 15 years have been very focused on retail financial services, and we're starting to see a lot of the innovations bleed over and begin to transform commercial and wholesale financial services, which is very exciting and I think opportunistic. There's a lot of old school technology and processes that are in that space. So excited to be here.
Matt, just a question around that in terms of how E&Y kind of bridges the chasm between startups and the big financial institutions. What kind of vehicles does E&Y have to kind of help, bridge that when there are virtually no commonalities between, how they work, how they develop applications, how they even talk?
Right. So one path is, or one capability we have is, as my 2 colleagues here to the right has indicated, we're very connected. We know a lot of people, and we're trying to make a lot of those connections for startups and for our incumbent clients. So as a connector, but perhaps more importantly, is as an enabler for how startups, how fintechs can be successful bringing their technology and their capabilities into an incumbent. Risk is something that's often overlooked and slows everything down. We have a unique capability in that area, and we're helping a lot of companies, startups get ready for working with an incumbent and understanding and anticipating their expectations and the questions that they're going to ask. And on the other end, it's helping incumbent financial institutions understand what it's going to actually mean to work with a fintech and how to transform some of their risk functions so that they can actually work with those companies in a much more accelerated way. There's a lot of things that slow that down, and ultimately the motivation for a startup as well as an incumbent is the same. They want to move fast, they're trying to, but there's a lot of things that prevent them from moving fast. We can work with them, we do work with them to help remove a lot of those things that slow down innovation. A lot of it's around the risk agenda.
Okay, and kind of, along the vein of continuing a deeper dive on each of the different areas that you guys represent, to what extent are startups really defining the future of fintech? And what are some examples in the way that the big financial institutions are leveraging the startups? A couple of, both you guys in the middle are talking about doing early stage investments. I've seen examples of a lot of the later stage companies like Affirm, Cabbage, Lending Club, et cetera, who have kind of built a critical mass and peeling away some of the financial institutions' biggest revenue and profit sources to the extent where it's having an impact, and so they're starting to either build alliances or to start investing in these. So, in an early stage realm, what are you guys seeing? Mike or
well, there was
Jeff?
A nice report in 2017 from the World Economic Forum that basically pointed out that what early stage fintech startups have done is change the landscape of competition in the financial services industry. So it's not about a startup taking a lot of business from a monster financial institution, but rather in terms of how they deliver to their customers, what their operating model looks like, what the technology back end needs to look like, the speed of execution, those kinds of things is what's really changed the tenor of financial services.
Yeah, I mean, if you look at Cabbage, which is a big Yodlee customer, an amazing company, really smart people doing really, really well. I mean, their volume is mouse nuts. It's irrelevant to a big bank. But Mike's exactly right. They're changing what you have to do to compete. And all these banks are going, wow, we have to be able to deliver a loan in 10 seconds or 10 minutes or whatever it is for Cabbage. And they're looking at just startups to help provide that functionality. And I think a lot about Casper. Like, Casper sells these mattresses that are as good as any other mattress. I don't know, my pillow top's really, really comfortable. I don't need a foam mattress. But what they've shown is, look, if you provide a better experience, people will come to it. And that's what I think a lot of banks are figuring out is, wow, these guys are providing a better experience. And frankly, we're better at lending than they are anyway, but they're more attractive to customers. And that's what you're seeing banks react to.
Well, when you talk about experience, are we talking about just the process that potential customers would go through to initiate a loan application, or are we talking about somehow the servicing? I read some articles about Cabbage about how even though it's a beautiful experience and they open up small business lending to a community that banks might not, they kind of charge usurious interest rates, and so it kind of flips the script on what you're saying. How would you comment on that?
So from my perspective, it's the entire end-to-end experience, and you got to recognize that financial institutions sell financial products. Startups solve people's problems, their perceived problems. So in my experience, a slightly higher interest rate is not as important as don't run out of money.
Okay.
Right? And if I can't go get a prime plus a couple point loan from a bank, right, my choice is, do I go out of business or do I start working with a partner that integrates well into my business?
Fair point.
Yeah,
And you could even extend that to like bank branches. When's the last time that you went to a bank branch and, well, one by choice, or two, that you went and had a great experience? I think most of those larger institutions have started to catch on that, okay, well, there's one easy kind of low-hanging fruit, which is let's go digital and create more do-it-yourself tools, which actually reduces their overhead, so it's good for their bottom line too. But I mean, Barclays Bank's a great example. They're getting rid of their branches and turning them into innovation centers to work with startups, specifically to be able to provide the bank's resources to these startups, but then two, have this kind of window into what's happening on the more macro trends of, they've got the data and they've got the capital, but the startups have the ability and agility to pivot and move around with whatever the customer interests are, as well as just kind of create new things that maybe the bank wasn't thinking about before.
I think just adding to that a little bit, I think everyone agrees they need to be more digital, less clicks, easier, both incumbents as well as startups. I think today there's also an increased appreciation that an incumbent realizes they have legacy debt, they have legacy infrastructure, they've got a lot of a lot of bureaucracy to how they operate, they are increasingly more aware today that they are dependent on innovative startups to actually create a lot of the innovations that they're going to need to consume over time. Whereas 5 years ago, that wasn't the case. I think there was various stages of denial, or I can do it on my own better. But now I think there's a lot of companies that realize they need to figure out ways to work with startups in a much more compelling way and faster way.
Yeah, I mean, you bring up a good point, and at the risk of going down, a rat hole with legacy infrastructure and all that other kind of stuff, because in kind of the pre-event discussion, we talked about how banks are sitting on all this data, and then one of the channels for innovation is, using all these new tools for analytics and artificial intelligence to kind of extract new value out of legacy data. I mean, is that kind of a thrust in any of the innovation, the incubation kinds of things you guys are doing?
I mean, yeah, obviously at a data company, we're very focused on data-driven innovation and trying to figure out how to pull more signal from the data, Yodlee's data, other data. We had a company in our last cohort that, based on your spending pattern, could deduce your personality and change marketing messages on the fly accordingly. That's really interesting. I talk to insurance companies all the time. My example is, should someone spending at Home Depot have some influence on their homeowner's insurance? Probably. And so we're always looking for people who are exploring that. And I'm seeing that just across the spectrum, using data, our data, other data, to provide better answers to, lending, budgeting, investing, et cetera, et cetera. And you're exactly right, not just at the consumer level, that's mostly what I see, but I see it happening at the wholesale level as well.
Mm-hmm. Yeah.
Now, in the realm of investing, and I'd like to hear from everybody, particularly the ones that are more focused in the startup realm, is what are the areas today that more of your investment interest and dollars are going? Maybe starting with Mike, because you're directly involved with going out, scouting pre-seed startup opportunities, making investment decisions. What kind of areas are you guys focusing on these days?
So, my partner and I sort of split the world, where he does a lot of B2C stuff and I do a lot of B2B stuff. But, if you look at the numbers from the last couple of quarters, generally speaking, B2B has been on the rise, and it's in areas not in payments and lending. So you see, insurance, and you see reg tech, and you see still data management, tools for financial advisors or bankers to make them more efficient. These kinds of things are the areas that are kind of interesting.
Okay.
If I see one more, I'm going to help you have visibility on your crypto assets. I will probably throw up.
Yeah, I'm trying to stay away from the AI blockchain hype cycle. We have enough panels that kind of talk about that. And again, just to my earlier points about, focusing on how startups are impacting the direction for innovations, and then how the big financial institutions are responding. So interesting point. Jeff?
We're looking a lot at real estate tech and insure tech, like everybody else, because it's just these huge markets that are ripe for innovation. We look a lot at things that aren't, at first glance, fintech. I see a lot of sort of B2B software companies, particularly aimed at SMBs, that are doing something involving finance along the way, and so they utilize fintech functionality, but they're not Cabbage, where that's sort of their entire existence is fintech. They are a B2B software company.
Would a company like Gusto be an example of that?
Yeah, exactly.
Okay.
Gusto, we had a company helping preschools manage their payments and cash flow and budgeting.
Is that a thing that banks have traditionally done? Maybe community banks or small type?
Well, in the case of these preschools, yes, banks did that. The preschool took a huge bag of checks to their branch and said, please deposit these. So yes, on some level, banks took care of it. And that's, to Mike's point, that's exactly what a startup does. We're going to solve the problem. We're not going to sort of say, we are a deposit-taking institution. We are going to solve your problem of walking to the bank with a bag full of checks every month.
I don't know what a check is.
if you ran a preschool, you would.
That was a joke. Come on, people.
Nicely done.
Jacob, how about you? Where are you seeing investments going in the startup realm?
So in the UK, I would say that there's a couple big areas, especially around compliance and reg tech, which actually kind of feeds into this B2B trend that Mike mentioned. There's also a lot of kind of on the more, I'm not sure whether it's really truly hype or not, but the challenger banks, these up and comers who say that, hey, we're going to be the new bank for the new millennia. Whether they really are or not, I'm not sure, but they're definitely pushing the incumbent banks to actually be more interesting, frankly. So that's kind of some big ones. The alt lending also definitely going down. So that one is maybe over. It's definitely not attractive
For now.
investment. Yeah, for now. I don't know. The ones that I really like and that I've been paying a lot more attention to is the compliance, reg tech, insure tech, maybe a little bit less sexy, but a lot more, I think, interesting.
It's interesting because another point is I wanted to kind of stay away from the regulatory. If you look at innovation in the financial industry as a three-legged stool where you have startups and corporates, you always have the regulatory bodies as in many ways an inhibitor of innovation, arguably for the right reasons. We can, argue whether that's true or not. But at any rate, so it's interesting to hear you mention about how RegTech is a major investment.
I mean, there's one RegTech firm that I can name right off the top of my head that everyone in this room has probably used in the last month without ever knowing it, and that's Onfido. They power the background checks that are used by like Uber. And many other companies, but they just kind of run in the background. They provide their services to other startups and other businesses, and you never would know that they're there.
Interesting. And where are they from? London? Mm-hmm. Okay, interesting.
Yeah.
I'd like to maybe offer up the panelists here as what startups are doing it well in the new realm. Some of your more newer investments in terms of working with corporates to drive innovation in a particular area, whether it's B2B, whether it's unsexy, consumer focused, whatever. Matt?
I can start. I can't name specific names, but because I'm precluded from doing so. But I think companies that anticipate, and this goes back to the risk agenda that I mentioned earlier. I mean, companies that anticipate what it means to actually work with an incumbent, their questions that they're going to have of them from a security, a cyber, a legal, and 4 or 5 other departments in that organization. If they anticipate that and they get ready, they are going to move faster and be more successful. So that's certainly one thing. I think the other is companies that are solving an existing problem, a known problem, a quantifiable problem, are very different, are getting more attention certainly from an investor perspective, versus those that have a technology looking for the problem that it can or could solve. And certainly blockchain is probably an area where there's been a lot of criticism of it in that space. But where there's a very specific use case and that's resonating with a lot of the incumbent financial institutions that have been struggling with that, there's a lot of opportunity for those companies, and they're moving a lot faster through their growth cycle and through their ability to sell into incumbent financial institutions.
Okay, Jeff?
We have a company, Genivity, that helps financial advisors sort of navigate the health issues of their clients. And they just signed a deal with BMO Harris. And Harris is going to drive this software out to their financial advisors. Again, that was announced last week, so we'll see how execution goes relative to what everybody's saying now. But I've talked to the CEO, I've talked to the person at BMO Harris, and they're all saying the right things. And this particular company is getting a lot of traction with financial advisory firms because they're solving a problem that advisors know they have. But I will also point out, they're not changing any core functionality. They're not forcing BMO Harris to innovate differently or put some new technology into its custodial back end. They are adding a new tool to the front end. That's a much easier sell into a financial institution than something at the core.
Okay, Mike, anything to highlight?
So I'll point to one, which happens to be my only blockchain investment. It's called Ohalo. They're a London-based firm. But they do data permissioning and governance for financial institutions. And that's something that's very difficult to sell into, right, for a startup at the time, an unfunded startup, to sell into financial institutions. Put all your data management on our platform. And so what they did was they created a subset of their functionality that would give chief risk officers, chief data governance officers, basically an instant view of their GDPR, their data privacy risk. And they offered, they could solve that problem literally in minutes. And so they, to Matt's point, they found a known problem with actually a deadline of are putting, 3% of your global revenue at risk if you fail to meet GDPR rules. And that allowed this early stage startup to begin building relationships with large institutions. And now they've also begun selling the rest of their blockchain platform into these companies.
Oh, wow, that's interesting. Is it safe to say that that is a regulatory-driven innovation kind of activity?
Oh, yeah.
With
No, I mean,
GDPR.
Financial institutions tend to operate out of fear, not greed.
Yeah.
So this is, fear of losing that much of your annual revenue, certainly.
How much of the piece of the pie in terms of innovation would you say is dedicated to either addressing or resolving regulatory kinds of issues? Is it small, medium, or large?
Given that about 30% of the average financial institution's OpEx is around compliance, and managing their legacy stuff, I would say that whatever they're spending, it's not enough yet.
Yeah. Would you say that's trending upward, downward, or is it kind of staying consistent? I
think and Matt may have comments to make about this, but I think that they are challenged. I can't answer the question up or down, but they're challenged to see how making a major shift in the vendors that they select will deal with the huge amount of their budget that has to go to remediating legacy tech.
I'd say it's probably in absolute dollars increasing, and probably increasing substantially, but there's other areas of OpEx spend on legacy and on modernization and innovation agendas, digital, that are growing at an increased rate percentage-wise. So,
yeah, I remember a number from 2016, I think. J.P. Morgan Chase spends $9.5 billion a year on technology. They spend about $600 million of that on fintech across all of it. So, drop in the bucket currently.
Interesting. Jacob, any startup? I mean, you mentioned one earlier, but any others that come to mind?
I mean, one that I absolutely love following right now is kind of fun is Flock. They do real-time insurance policies for drone pilots. So you go out, you pull up your app, it'll check the map for any geographic risks around you. It'll pull from the weather service what the current weather conditions are looking like, and then it'll ping Allianz to create a custom insurance policy for that drone operator, that particular drone in that location for however long they want it. Because in the UK, you have to have insurance if you want to go out and fly a drone. And so this kind of fits in this nice little kind of sexy package for these both hobbyist and semi-pro drone operators. Once you start getting beyond that to fully commercialized, then it's a little not as cost effective, but they also are able to then take this technology and what they're learning from that and are starting to work with these different autonomous drone companies to be able to create a system where these different drones could actually ping the service and create their own insurance policy before they take off without needing the human intervention at all.
It's a different driver for innovation. With the development of drones and applications around, that's interesting.
Yeah.
We're kind of, getting close to the end of our time here. Do we have any questions in the audience? It's kind of hard to see with the light. Any questions on anything you've heard or anything maybe you haven't heard? Because otherwise I have another
Come on, you're much more
I have another question myself. So
must have something.
If you don't have something.
Yeah.
There we go.
Okay.
There's a recent survey that showed that about 60% of millennials are interested in having all their financial information 60% of millennials are interested in having all their financial information on Google or Facebook. I'm wondering what you all think about the announcement recently that Facebook has been trying to talk to banks about sharing their financial data with them. Where do you think that's going to end up?
Nowhere.
That was bad timing for Facebook. Yeah. I think last year that might have been an interesting discussion. They could have gone places. This year, it's hard to see how that goes anywhere.
Yeah, I'll go along with that. I don't have to add more. I'll share one perspective, which is I don't think that any of, I refer to them as GAFA, Google, Apple, Facebook, Amazon, really want to be regulated financial services providers. But I also don't think that they are willing to wait for the traditional financial industry to solve their problems, right? How do you provide a loan to a customer at the point of sale instantly? So if they can't get their problem solved by the traditional financial industry, then they will find a way to solve it for themselves.
We have a question over here.
Question for Jeff and for Mike. Are there any specific spaces that you guys have found that you're super bullish on, or is it just simply product team specific that you guys either invest in or bring on board?
So again, I invest at the very early stage, and generally speaking, I look for companies, new ideas, new perspectives on problems that have not received a lot of investment in, call it, the last 4 to 6 quarters, right? So I'm not interested in consumer lending today. I'm not really that interested in new credit analytics today. If you can bring me something in trade finance and trade insurance, that's kind of underinvested right now. I think wealth tech is underinvested. I think reg tech is still underinvested. I think property tech is still underinvested.
I have a slightly different mandate. Since I'm not taking equity, I'm not necessarily trying to make a ton of money. My focus is more what's new and interesting, what drives the sort of use case envelope for data, in particular Yodlee's data. And that being said, I don't let in terrible companies, but I'm willing and able to take risks that Mike shouldn't take because he's living on 7%. So normally I'm on these panels with Mike's partner, Sheil, and usually we're elbowing each other out of the way to say, no PFMs, no PFMs. So that's one area that we really don't invest in, is PFMs.
Agreed.
Okay. Any other questions? Here's a question over here.
Can I just ask a quick question about crowdfunding, and in particular equity crowdfunding? Because a couple of years ago, that was one of the sort of hot subsectors within the fintech space, and it's kind of been overtaken a little bit with the sort of stuff we've been hearing today, reg tech, insure tech, and other sort of sub verticals. Is that because in your view, things have just kind of fizzled out in that space? The whole idea of disintermediating investment banks and all that sort of stuff that was hyped up to do was quite interesting. And then the second question in relation to it is, the thing that's always struck me about that market is the UK has been very strong on it, and there's been a lot of stuff going on there with equity crowdfunding. Likewise, the US has also got all their crowdfunding platforms doing their thing here, and there's never been that sort of bridge and that attempt to bridge the the Atlantic to try and bring those platforms together. I know a couple of the platforms in the UK have tried it, but not really got huge traction with it. Do you have any thoughts on that space generally?
I haven't seen a crowdfunding application in 2 years. We had 111 applications last year, not one of them was crowdfunding.
I wish I could say the same thing.
One thing is I work for Launch, and we're an early stage kind of investor, kind of development community. We've had Seed Invest and Republic as two of the equity crowdfunding platforms. If we're just talking about an alternative, the way they talk about it is it's around the democratization of startup investing. So you no longer have to be an accredited investor to invest in startups, and you can invest as little as $25 or $50, for a piece of a startup. So there's these new platforms that have emerged. fairly, I mean, they've been around for a while, but it's just, the environment has changed either from a regulatory perspective or from just, people's mindset changing around, how investment in startups, can be achieved. I'd say there's tremendous promise there. The due diligence process for these platforms is like 10x more complex to do it, but the payback can be great because it opens up just anybody to be able to invest in startups. As far as what's going to happen, Jacob, maybe you can comment on it. What's happening in the UK, but right now it's the way I see it is just more from a U.S. perspective.
I think now that you give me a chance, I think there's three factors. The first one is there was so much excitement about it previously that basically the world is digesting what's happened, right? So AngelList and Crowdcube and a couple of others, did pretty well, and now everyone's trying to figure out what's next, right? The second thing on the crossing the pond in one way or another, early stage investment they tend to be driven from gut, right? And if I know nothing about the UK market and I'm sitting here in Silicon Valley where there are tons of opportunities for me to invest, I'm not really going to look elsewhere, right? Because I really don't know anything about the UK market, and I don't really know anyone who I'm comfortable trusting, having done the due diligence at the earliest stages. And then the final thing is we do see a couple of new experiments that are indeed interesting, right? But they're very specialty ones, and unfortunately they're often tied to, well, the cryptocurrency is going to make it all possible, when in fact, it's just a tool. And so, for example, we've seen a couple of companies that are interesting that allow foreign investors to buy into commercial real estate projects.
Okay, I think we have time for one more question. Right here.
Visa, MasterCard, American Express, they get 2, 3, 4% of a $10 transaction or a $5,000 transaction, which is kind of ridiculous. You see anybody trying to take those guys out?
There's lots of folks that are trying to create price margin pressure in the payment space. I don't think in general they will be taken out, but they will have to earn their living by providing additional value.
The thing is, a lot of them still run on those traditional rails too.
Yeah.
There are very, very few people actually building that true infrastructure layer. I think actually saw a few of them yesterday in the different blockchain talks.
Is Stripe a potential for that? Or are they more in the partner realm?
I would place them more in the partner realm. What do you guys think?
Yeah, they'd have to get a lot bigger to turn on their partners and say, we're going to get rid of Visa and MasterCard.
So I'm saying at some point they might get a critical mass that's interesting enough to where they start doing the underlying settlements themselves. So I've seen that happen in many other industries, but just a crazy thought. Matt, any thoughts on that?
I agree with everything that's been said. I mean, I think if there's fintechs, and there's a few out there that can go from point of sale back to settlement at the financial institution of the consumer or some sort of credit facility, that's the only way you can eliminate the traditional payment networks. I think the traditional payment networks are still going to be leveraged. They're not getting 2 to 4%, I don't think, on average. Their take rate is much less these days because of all that pressure.
Okay, great. Well, I think we're pretty much out of time, so just give it up for the panelists. Hopefully it was interesting for you.
Okay.
Thank you.